As you look to buy a US property, you're thinking, should I buy it in my own name? Should I have a US LLC? Is there a different structure? How am I going to make sure that I have the minimum amount of liability that nobody can come sue me or to go over my assets? And how will I make sure that there's no double taxation? I'm going to talk about that and go through each structure, telling you what's good, what's bad, and what you shouldn't do at all. Here are my 5 best structures for the US real estate investments. Hi, I'm Sal, a US tax CPA in Toronto, helping Canadians just like you invest into their US real estate and get their maximum refunds with a minimum amount of tax. So as a Canadian, you want to invest into US real estate. Very popular, very common. There's a few different structures you can use. The first one is obviously the simplest one, just doing that in your own name. And that's completely fine. It's very simple to do. You don't need an entity structure. You just go and buy the property, let's say Florida, wherever you want to buy, and you just buy it in your own name. The way to fund it would just be sending a wire transfer from your Canadian bank account to the lawyer or the seller and just go on from there. If you want to talk about taxes, right, there's 2 streams of income that the property can generate. One would be rental income, or when you sell it, the capital gain. In terms of rental income, you'd be taxed in your personal tax return. So that'll be a 1040 NR. And that's basically a non-resident US personal tax return. It's going to be taxed at the income tax bracket, which probably is going to be low given it's just rental income. To do the tax filing, you first need to have an ITIN, which is basically an individual tax identification number for the US. It's like a SIN, but for foreigners in the US. So you're gonna get that, and you're then gonna file your taxes at the end of the year. How you get an ITIN really quickly is there's a form called W7. You have to submit that with your tax return, the first tax return that you're doing, and you're also gonna send a certified copy of your Canadian passport. The way to get that is from Service Canada. You just get your certified copy. It comes home in your mail, I think about in 2 weeks. And you want to make sure that when you're sending this, you also attach the PDF page of the Service Canada website, which says that we're no longer embossing copies of our certified passports. This is something new in 2025. Basically, to give you a bit of a history, up until 2024, what they were doing is they were embossing the copy of the passport that they send out, and the IRS was used to seeing that. Suddenly in 2024, they stopped doing that, and the IRS got really confused that maybe these people, like for example yourself, who's submitting the W7 form, the ITIN application, along with that certified copy, are they making a fake copy? What's happening here? There's no embossment. Service Canada put it on their website that as a matter of policy, we're not doing that anymore. So that's on the website. You just want to PDF that and print that and just put that in your tax return. Let's talk about the second option, holding it in an LLC. So this is a very common practice. And if you go to a US lawyer or a US accountant, they're definitely going to suggest you do that. And there is some benefit to it. The benefit is that you have liability protection. So for example, if your tenant or somebody else is going to sue you, you do get the benefit of them not being able to come after your Canadian assets. They can obviously still come after your property in the US, but they cannot come after your Canadian assets. Similarly, if you have 2 or 3 properties, you have 2 or 3 LLCs, they're not going to be able to come after the other one. They're only going to be able to come after whatever down payment or whatever funds you have, equity you have in that one property. So a good option for Americans. I'm going to come to why it's not a good option for Canadians. The problem with an LLC is that it is not taxed the same way that it is done in the US, how it's done in Canada. In the US, it's a pass-through entity. The rental income or the capital gains when you sell the property, when you report it, you're going to report it in your personal tax return in the United States. That's how Americans do it. However, in Canada, it's treated as a corporation. It's treated separate from you. So when, for example, you have rental income of $30,000, you pay, let's say, $3,000 to the US government as your tax. When you try to report that income in Canada, you obviously want to also report the tax you pay to the IRS. because you don't want double taxation. Unfortunately, the CRA does not recognize that. Long story, I talk about it in a different video. The CRA thinks that the tax you're paying for your own self in the United States because it's a pass-through entity. It's reported in your personal tax return. There is no proof that you've paid it on behalf of the LLC. So when the CRA is looking for foreign tax credits, which is basically tax that you pay to the other country that you want to take as credits in your tax return, they're not able to support that because they say that's what you've paid for your own self. There's no tax that you've paid for the LLC. And you can try all you want, they're not going to take your word for it. In simplicity, for Canadian, an LLC is a bad choice because you're going to get double taxed. But if you set up an LLC, I can still talk about the tax and the withholding on it. So the tax form for an LLC is still a 1040-NR, still an ITIN application, just like if you held the property in your personal name. You would add a Schedule E, which is basically you're reporting your rental income. And then in Canada, you're going to report that same income. And the way to fund the LLC is just to send a bank transfer from your Canadian bank account to the LLC's bank account and then go on from there. To open an LLC bank account, again, I'm talking about it in a different video, but you need an EIN, an employee identification number, and you can apply for that using an SS4 form, submitting that to the IRS, and just going from there, you're going to get an EIN, and you use that to get a bank account for your LLC. The next option is a US C-Corp. A C-Corp is a traditional US corporation, and it is a much better option than an LLC because you don't have double taxation. You get taxed in the United States at 21%, and then you flow that income back to Canada as dividends, and then you get taxed in Canada. It's much better in the sense of double taxation, but it's not so good because you're paying 21% tax. If you're aware of Canadian corporate tax, it's 12.5% for Ontario and a bit up or down for other provinces. So you are paying a little bit more tax. Better than an LLC, not the best option. Let's talk about how to fund it. To fund money to a C-Corp, you literally, again, send a bank transfer from your Canadian corporation through to the C-Corp's bank account. For the C-Corp bank account, you again need the same sort of documents. You need to apply for an EIN, an employer identification number, and for that, you need to fill out the SS4. So first, you're going to create the C-Corp in the United States. You can create it in Wyoming, or you can create it in the state you actually are going to hold your property. You're going to then use the SS4 form to apply for an EIN, get the EIN, open a bank account, fund that bank account, buy your property. So moving on to taxes, you're going to file an 1120 form, and that is basically a corporate tax return for the United States. You're also gonna then have a state filing. So for example, if you've got your property in Florida, there's no tax, state tax, so that's fine. You got in Texas, again, no state tax. Most of the other states, you will have a state corporate tax return to file and corporate taxes to pay to that state. Unfortunately, in the United States and per the US-Canada tax treaty, if you've got real estate in the United States, you are gonna get taxed there first, and then you're going to take that income to Canada. So there's a separate scenario if you've got other types of income. The US-Canada tax treaty does stop you from having to pay tax to the US government on other types of business income. I have a different video on that. So once you've paid that 21%, is that all? Unfortunately, no. When you take that money out as dividend into Canada, you're going to pay a withholding tax. Now, withholding tax is actually usually 30% for foreigners, but because we have a tax treaty with the US, it actually goes down to 15% if you're an individual owning that C-Corp. If you're a Canadian corporation owning that US corporation, it actually goes down to 5%. That's not automatic. You have to file an election to do that, and we can definitely help you out with that. In simplicity, it's 15% if you're holding it yourself, 5% if you're holding it through a Canadian corporation. The last option, and my favorite, is to have a US limited partnership. A limited partnership is basically a US partnership which has a 99% limited partner and a 1% general partner. What that is, what's the difference? I think it's too complicated for the purpose of this video, but in simplicity, it's you owning the limited partnership 99% as the owner and having an LLC own it as a 1%. You just need to have obviously two people owning to have it to make a partnership. An LLC over here is fine because it's only a 1% owner. It's only going to have 1% of profit. There's no double tax on 1%. The limited partnership is different from the other structures because it is the only structure that the US and Canada tax treaty recognizes in the same way in both countries, and it has the minimum amount of tax to pay. Basically, both of them recognize it as a partnership, which means that when you pay taxes in the United States, it is taxed in Canada in the same way, and you don't have any double tax to pay. So let's say you made $30,000 of income. You're going to flow that up to the two owners, which is 99% yourself and 1% your LLC. To make things simple, let's just assume it's 100% yourself. Your limited partnership is going to flow that income back to you and issue a Schedule K-1. That is basically just reporting the distribution it makes to you. And you, as the owner of the limited partnership, are going to get taxed at the tax percentage or the brackets that apply to you. Now, with a limited partnership, you do get liability protection. So that means that nobody can come after you in Canada, but they can come after your assets. So if you've got 2 or 3 properties under the limited partnership, they can definitely come after each of them. How you can stop that is having LLCs below the limited partnership. So for example, you got 3 properties, you can have 3 LLCs owning each of your 3 properties. And then that way, one tenant, if they sue you, can only come after your equity in that LLC or that house or that property. Having this structure, you can completely rid yourself of any liability, any double taxation, and you're also paying the minimum amount of tax possible. Only downside is that you've got multiple entities, multiple tax filings, and obviously that comes with a cost. But I would definitely recommend this structure to anybody who's really serious about their properties and they really want to get into real estate big time. The last structure I want to talk about is the same limited partnership, but instead of you owning it, you have your Canadian corporation owning. The benefit of that is that if you've got a lot of income that's coming from there, let's say you've got capital gains or you've got a ton of rental income coming, you're not going to be paying higher taxes, right? This is especially important if you've got other sources of income that are already taking you into the high tax bracket. So a Canadian corporation gets taxed at 12.5% as compared to you being taxed at 50, 53, or whatever it is in your province. I definitely recommend this for people who have even larger portfolios, multifamily real estate, lots of different properties, that they can lower their tax bracket from like 53% to like 12.5%. So in summary, you can own a property in the United States in your own name, and that's very, very, very easy. And definitely you should do that if it's just one property that you're going to own. If you're trying to get more serious, I would definitely recommend looking into a C-Corp, but obviously an LP is much better, a limited partnership. And if you're really taking things to the next level, a limited partnership with a Canadian corporation. We have set that up for our clients, and I would definitely recommend hiring a cross-border accountant to do that because it's not easy and you probably might make a mistake and get double taxed or do the wrong kind of setup. But that takes me to the end of our video. Thank you and see you in the next one.